Not going to succeed. Or, yeah, that's Chris over there. My name, as it says on the slide, which we modified yesterday, is Anya Sri-Skanda-Rajah. Good morning. I'm responsible for heading up the Guy Carpenter Analytics Department for Canada, and Ken Mock is a full-time catastrophe modeler in our office in Toronto. And yeah, we had a bit of a change-up, so apologize if this isn't the smoothest of presentations, but hopefully we can deliver the material to your satisfaction and endeavor to answer your questions as best we can. The topic is timely and interesting. We thought we'd cover it in this. We'd start out with the current landscape, what's been happening recently in terms of catastrophic events and also within the catastrophe market. Talk a little bit about model availability and usage for Canadian perils, as well as enhancements to those models in the future. And we close it off with managing model change and uncertainty, which is again tied to some of the recently released draft guidelines coming from OSFI with regard to earthquake risk, and talk about model results blending and customization and sort of owning your results. So we can start out with, I suppose I should have said that I'm going to cover the first bullet there. Ken is going to take the second and third sections, and then I'm going to close off on the fourth and fifth section.
Are you fine with questions along the way?
Absolutely fine with questions along the way. So in terms of the current landscape, this is obviously not news to anyone in this room or connecting with us by phone. It was a really active cat year in 2011 in Canada. Actually, the third highest in our history, surpassed only by 1998 and 2009. 1998, obviously, driven by the ice storm, and 2009, primarily Alberta weather. There were some surprises, obviously. Slave labor fire being the most clear example. Anyone in the market really anticipated a $7 million claim from a wildfire in a relatively remote part of Alberta. But these pictures, by the way, this is the July thunderstorm in Alberta, in the prairies. This is the Godrich tornado, and this last one is the windstorm in November of 2011. And this, while obviously more severe than prior years, is sort of consistent with about 4 or 5 years of significantly increased frequency and at least moderate severity in Canada. In addition to that, in 2011, on a global basis, a great deal of activity. This is just global cat events midway through 2011 versus midway through 2012. The reason we're focused on midway through is because we're about to talk about what the cat market is doing in the cat market, and that's sort of what they know going into the January 1 renewal for the coming year. These losses were driven by the Japan Tohoku earthquake, and I've just completely blanked on what the other two major events are. I'm going to refer to my notes here. New Zealand was, early. Well, there was an event in 2010 and then January 2011, and the Thailand floods. All three of those, in their own way, are unanticipated. Christchurch earthquakes took place in a previously unidentified seismic zone, so nobody was contemplating any earthquake losses from that place. The Japan earthquake, in terms of magnitude, in terms of the tsunami following, and in terms of the nuclear potential fallout, all, in several aspects, unprecedented and unanticipated. And the Thailand floods, while not impacting directly the major insurance markets, from a contingent business interruption perspective, had a lot of ancillary damage, also previously uncontemplated. So backing up to before this big spike of $76 billion and before all of these Canadian events in 2011, the January 2011 catastrophe market was relatively soft. Now we have the other lines of business there as well, although this is a catastrophe risk presentation, because the appetite of reinsurers for one class of business versus another can transfer capacity from one line to another. So it's not just about the events, but also the relative attractiveness of these spots to place capacity. The 2010 Ontario Accident Benefits loss ratio for the industry was about 150% average. So reinsurers were not feeling very inclined to write a lot of casualty business, and when so doing, we're going to be very careful about it, which transferred capacity to the property market as well. Catastrophe experience in 2010 was relatively benign, and so we were facing a pretty soft market. Fast forward a year, and in many ways, Canada had, forgive the pun, the perfect storm. We had a lot of local Canadian cat activity. So all of those low-layer catastrophe covers had experience-related rate increases and hardening. But then the world had a lot of really terrible experience as well. So all that top layer, remote likelihood, was under pressure and getting hard. And also, lastly but not least, all of those events happened in what reinsurers would refer to as cold spots or non-peak zones. And the reinsurance market's view of what kind of exposure is represented by non-peak zones shifted dramatically from benign to be careful. And so that further hardened the catastrophe market. And I have not done any study of it, but I do feel that in many ways the Canadian market was one of the hardest markets in the world for catastrophe reinsurance in 2012. Property, there were a few large losses popping up locally in Canada, so the risk is not soft, not hard, sort of middle of the road. And the logical shift of capacity, the Ontario auto reforms took effect through 2011, made reinsurers more comfortable about writing auto casualty, and so the logical place for the capacity to flow was there. Coming into 2013, we really haven't had a lot of Canadian cat activity, fortunately, and we haven't had a lot of worldwide cat activity either. So it looks relatively disciplined, not too soft, not too hard, kind of middle of the road. Again, casualty may be a little bit softer because of the continued good experience in Ontario Auto. I know, obviously, that auto casualty is more than just Ontario Auto, but it's the lion's share of the exposure and also the loss activity. So that's just to set the stage for what environment we're working within, and the things that shape the behavior of the reinsurance market catastrophe also are the things that shape our own view of the risk. Actually, one thing I neglected to mention that contributed also to the massively hard environment for 2012 renewals was RMS version 11 in the United States for hurricane, U.S. hurricane, which represented not only a big increase in the PMLs, but also a big shift in which exposures were driving those PMLs. And for local writers like, say, Florida companies, it suddenly dramatically changed what their own view was of which risks are better risks than others, which risks are more exposed than others, what is adequate pricing for this. And so there was a big period of uncertainty both on the primary side and also on the reinsurance side in terms of what is happening with these PMLs and then what is the associated pressure from a regulatory and rating agency perspective. So now we're going to get into locally what can we do about all of this uncertainty, what tools do we have available, how can we look at this risk.
Thanks, Sherry.
You're welcome, Krista.
Okay, so I'm just kind of going into the models a little bit, since Anya's kind of give you the landscape and the renewal process. So I guess before we start into this, it's always a good reminder of what these cat models are intended to do, right? I always get the joke at work, okay, Ken, can you just push the easy button, give me the PMLs? The brokers expect me to get, the results within a couple hours, but it's a big process, it's an intricate process, and, if we could all push buttons, we could all be cat models. So So just kind of briefly a reminder of what these cat models do and what kind of results they get and how to kind of interpret these results. So some of the questions that come up for cat modeling: what are the future events likely to occur? When they occur? How intense are they? After the events, what are the insured losses? And what are the ranges? Again, I stress range because these cat models, when they come with a number, it's not just that number. There's a range in terms of that loss. So just kind of when you're thinking about the cat modeling process, the process or the numbers is not a crystal ball. So when you look into your results, that's not going to be the answer of the loss when it happens. So it's just a guideline. So keep that in mind. So kind of going through the evolution of cat modeling, it all started, there was no cat models. Data was poor, no models available, couldn't really get probable estimates of these losses that would happen. Data became a little bit better, events started to happen. So in 1982, Hurricane Andrew happened. Big event, kind of drove the industry. People started to look at these models. Oh, they're great tools, start to use these to help make business decisions. As it kind of evolved, 10 years later, approximately, World Trade Center happened. Obviously, big loss. Models became kind of robust, but obviously, you know, they need criticizing and stuff. So, and new perils started to evolve, terrorism after 9/11, and then the between casualty and property loss. People needed to know not just property losses, but casualty losses also too. So as we kind of evolved, 2005. Well, we kind of already have the cat models kind of in place. They're pretty robust, but then Katrina happened. It was a good wake-up call because, you know, people started criticizing the models. Insurers looked at their losses versus model losses and kind of compared them. Sometimes they were way above, sometimes they were well below. So how can we trust these models? Again, the ranges. So it's good that, unfortunately, these events happened, but they helped recalibrate the models. So with 2005 Katrina, the models started readjusting their event set, recalibrating the frequency like that, and looking at where to update the models and took the good and the bad from events. So we got claims information, kind of helped update the models. And then 2008 happened, financial crisis. So the rating agencies started to really drill down to the models, like what components of the models are good and what components are bad. So when filling out, for instance, SRQs, really drill into which part of the models, what part of the exposure model, what part of the models are good, and really just kind of dissecting the models. Going through the evolution, it's kind of important that events happen, but they help trigger updates and help evolve the models. In terms of modeling vendors out there are really only 3 big modeling vendors. RMS, which, again, kind of like when Andrew happened in the early 80s, RMS kind of expanded, came out with a model, full suite of models, perils that we're able to model. AR and EQE are the other 2 models within the industry that are widely used. AR came out in 1987, and then EQE, another model, one of the first models that came out for catastrophe industry. Other, and not necessarily big 3, but there are also reinsurers and brokers that actually have in-house models that we develop. So they're not commercially licensed, but those are some of the models that are available for catastrophe modeling. In terms of the Canadian landscape, RMS, full suite of perils. Earthquake, fire following, quake, SCS, severe convective storm, which is a makeup of sub-perils, tornado, hail, lightning, straight-line wind, winter storm, which was introduced in 1998, sub-perils, freeze, snow, wind, and ice, and then hurricane, which was just released last year. EQE, not a full suite. They only have quake, fire following, and then AIR, quake, fire following, and wind. So those are models that are available. What's also important is the vintage of the model. So the model is only good if it's updated and current with all the hazard information. So if you look at the vintages, And each peril, you have RMS, kind of breaking down by peril now. RMS last update was in 2009, AIR 2005, which is, it's pretty outdated now. Almost time for an update, I'd say. And EquiCat, they just released a new model last year, so it's quite relevant. Fire following is correlated to quake, so same time period. Severe storm, last update for RMS was 2008. AIR, again, pretty outdated at 2005. EquiCat doesn't have a severe convection storm. Winter storm, the only model that's available is through RMS, and that came out in 2008. So they haven't updated it. It was just introduced in 2008. So no updates since 2008. And hurricane, again, just released last year for Canada. Breaking it down by peril now. So for each peril and how it's kind of perceived within the industry, RMS is widely used. It kind of capitalizes the market. It's pretty easy to use. You can send databases to reinsurers for pricing. The other models are not as robust in terms of trading data. EquiCat, it's not as user-friendly. So in terms of the market, RMS kind of dominates that, which is unfortunate.
No, I just find that interesting that someone's dominating the market because the very first reason is because it's easy to use. It's like, as to relate is how accurate is it?
Exactly, and that's why
it's kind of strange because you'd be more concerned about the accuracy than the ease of use. If you're dealing with millions of dollars, you can buy the people to use it.
Yeah, it's not just ease of use, but it's also how much usage is kind of within the industry. Like, so more people license RMS, and also the vintages, like my last slide, right?
Mm-hmm.
It's been updated late 2009, AIR 2005. So it's not the same in terms of the year, in terms of updates. So US, they might have more current stuff, but for Canada, looking at 2005 for AIR. So in terms of which models to use and how to kind of gauge how relevant they are, kind of look at the vintages also too.
But the updates would be done essentially from government information.
Yeah. Like, for instance, the Canadian Geological Service and stuff like that. RMS is, I'd say, the most dominant model currently, but as we evolve, and I think everyone should look at, is the multi-model approach. You can't just, as you mentioned, you can't just look at one model because it's a range and it's good to take various ranges and different models. Last update, again, I mentioned my old slide, 2009, major update in RMS. Western Canada PMLs, which most people look at, there's two zones in Canada, Western Canada and Eastern Canada, and numbers increased dramatically, 30%. So it kind of created a roar in the industry, saying, oh, great, I have to buy 30% more protection. But again, if you kind of multi-model approach, just because one model goes up 30%, do I buy 30% extra, right? So, but that was just kind of indication of how much models can change. EquiCat, it's used. Some of our clients license it, and they just came up with a new update for Quake last year, and they're actually reinventing their model. The framework's changing, so speaking of ease of use, they're becoming easier to use. So the whole interface and everything is changing this year. And AIR, again, they're pretty outdated. They're coming up supposedly in 2014 with a whole suite of updates and perils. Looking at severe convection storm, again, RMS, AIR, kind of your two top models in terms of usage. Last updates were 2008 for RMS, and where the numbers went, they decreased about 30%. So RMS quake, as we saw on the last slide, increased. For SCS, it actually decreased. But again, these are based off of industry numbers, so we can't just make the assumption that every client and every book of business decreases. So it can be pretty specific to a certain book of business or a certain client. So don't just take that 30% stick guideline. And for SCS AIR, last update, again, 2005. Winter storm and hurricane, the only models that actually have this peril available is RMS. Winter Storm was released in 2008, and that was, 10 years after the big ice storm in Quebec. So big events trigger model development. So hopefully it doesn't take another big event to build some of the other non-model perils. Hurricane, new peril last year. Again, it's out there. People can use it as a guideline, but it's still relatively new, so people are still kind of dissecting them all, trying to understand these perils a little bit. So here's this kind of study that we did. We took one model, this is RMS, and we took their industry exposure database. So this is the information they gathered to build their exposure database to come up with these losses. So if we break it down by peril and by region, you can see Alberta there is driven by severe convective storm and winter storm. Looking at British Columbia, perils kind of affect that region. You have quake, obviously, no surprise, severe convective storm and winter storm. Ontario, Quebec, you have all the perils affecting that region, and then the other. So if you look at this chart, kind of summarize, quake makes up about 30%, winter storm and SCS about 30% also too, and then hurricane is pretty small compared to all, just because Atlantic hurricane is not going to affect across Canada, it's going to affect the eastern part.
Yeah, Virginia.
Sorry, before I switch, this is the average annual loss. Before I go to the next slide, just to kind of highlight, average annual loss is the long-term average of losses that would occur in any given year in a book of business. So this is taking the average of all the events that could happen. If you take this same kind of analysis and you go over, looking at a 400 return period rather than the average annual loss, looking at kind of like top layer events, layers, and how people set up the reinsurance contract. So not taking the average annual loss of all losses, looking at severe losses only. So Alberta, given just really driven by severe convective storm and windstorm. British Columbia, again, look, it's pretty dominated by quake, and then Ontario, Quebec, and the other.
Ken, can I just ask you a question?
Sure.
Matt, I'm just curious why you use a 400-year return period. I know in the primary markets, you're talking about the 100-year, the 250, and the 500-year.
Yeah, okay, so
and now you throw up the 400-year.
So 400-year return period, kind of, if you link it to OSFI in terms of regulatory guideline B9 and how much insurance companies have to buy, they have a blended average between the 250 and the 500, and they have to buy a certain amount of limit. So if you take a blended average, and 400 is not going to be the number for every single company, but it's around how much you need to buy in terms of cat reinsurance.
So that's a common term that reinsurers would look at, is a 400?
Yeah, so the goal is to get up to 500-year return period. The goal is to get up to buy enough protection to 500-year by 2022, and it probably is going to change to a Canada-wide, but we're not sure yet.
Okay, so
it's kind of
an escalating mark with
so 500 kind of, target is 500, so we're in between the 250 and the 500.
Thanks.
And if I can, just one other interpretation between the two. So the difference between looking at the average annual loss and looking at the 400-year return loss, more of the cat cover that a primary insurer would buy would likely be focused on the 400-year. And if you compare that with the annual average, for example, Alberta being much lower than British Columbia, looking at the 400-year average, and closer when you look at the average annual, that would mean that the primary companies are retaining more of the storms that come kind of regularly in Alberta, whereas in BC and Quebec, there's a greater role for cat cover and transferring or sharing the risk with reinsurers.
Yeah, so if you look at average annual loss, that kind of looks at all the events, even the small events. So when you look at this, just taking the severity events, that kind of shows you what they buy up to and what perils.
I want to clarify, actually, this the definition of what's graphed here is an OEP basis. So it's the single largest occurrence in a given year. at this probability level or this return period.
Yeah. And Paul, if you took that.
Whereas the other one, it has multiple events, and so it reflects also the risk of frequency and accumulation of cat, not just the single largest, which is what you're using to make sure you have sufficient limit to protect you in the event of the largest loss. And then, of course, that limit's available also for all the smaller ones that happen, if they should exceed the retention. But that's not reflected in here, that there could be multiple. That's why Alberta shrinks so much, because their main peril is severe convective storm. And there's, you know you're going to have a certain number of hailstorms a year and thunderstorms and things like that. So those are not reflected here, that you can have multiple severe events.
That's why you can see BC and Quebec. They're obviously at the top range compared to the other provinces.
And I guess the type of reinsurance you're buying, or whether you buy, I forgot the exact term, whether you buy that reset that allows you to reset your reinsurance program, that reinstatement, that really affects how these models will affect you then. Whether you're dealing with a potential single event, or whether you're dealing with a cumulative event.
Yeah.
Because you're going to want that reset.
Yeah. So looking at, again, everyone's not just interested in one model, so taking two models here. Due to licensing, we can't really release the names, but I think probably kind of gauge what numbers and which vendors they are, because there's only three. So taking X and Y here, X being the small model and Y being the larger number, you can kind of look at the indexes in terms of the industry exposure database that each vendor uses and models the losses. So here, if you look on a Canada-wide basis, you see the models are somewhat kind of close. You have, between 1.8 to, or 1.6 and 1.39 at the 400 and 250 for Canada-wide quake. British Columbia, 1.15 and 0.88 is actually lower for this one. And then Ontario and Quebec, it changes a little bit. So there's more discrepancy between the models, between Ontario and Quebec. And notice here also too that if you look at the return periods, you have less than 2 in terms of index between two models. But then once you get to Quebec, you have a bigger index, and then even larger difference between the tail end. So if you look at the 400 and the 500, and then higher, if we had more data points, it actually increases the index. So that means the two models are vastly different between the tails.
Can I make a little side comment? First of all, the models may not be, you may have a preconceived idea about which model is which, like which model is which of the three. They may not match what you think, or your guess. And there's no significance between, X is the smaller and Y is the larger. It's just for convenience of calculating the multiples, the one of the other. And the differences that you see there can be due to the model assumptions, and also due to differences between the exposure databases. Because these models are each run on their own view of what the total industry values look like, what they're made of, and so on. So, yeah.
Yeah, thanks for bringing it up. So, comparing, when looking at the IED's exposure databases, one might, for instance, taking a small number, one might say it's 1 billion, one might have a 1.5 billion. So again,
TIV.
Of exposure, TIV exposure. So you're already starting from a different point. So modeling that exposure through the models, and then through the difference in terms of hazard and the vulnerability, how each model changes it, you're going to get vastly different answers.
Have you run a similar variable on specific portfolios that reflect what your clients are, and
so
that ratios match up with what you show?
Again, that's why Anya highlighted it. This is based off of the industry databases. So what you model for a specific client or line of business is totally different. So you can't take this same index because this represents all of Canada. That specific client might be only a niche writer or a regional writer, so it won't match this IED.
One of the challenges of model verification is you have to start experiencing earthquakes or events, and so Northridge and Katrina and whatever were critical for helping to understand where the model strengths were and where improvement was needed. My sense within the Canadian discussion, certainly in terms of where the Institute's been asked to do some supportive research that would be available to modelers on things like soil conditions or whatever have usually been talking about uncertainty in British Columbia and why the model's not exactly giving the same number for British Columbia. But these numbers are more close together for British Columbia, more apart on Quebec,
Yes.
for example. And we've actually had less questions from the industry, even though we're doing similar research in Quebec that we give to the Geological Survey or whatever to release. How do you work with clients when you're aware that the models are giving quite different numbers, in particular for Quebec, and the clients need to make decisions about reinsurance purchases or decisions about managing Quebec exposure when there's this variation in price for the models?
Yeah, so we try to point out, obviously, again, going back to model vintages in terms of how relevant their hazard information is, taking the good points from the model, bad points and stuff, so helping our clients really dissect the model. And I think Anya's going to really touch on that in terms of model suitability afterwards. So what our job is, really, here's your number, but it's not going to be that number, help explaining them, really, I guess, dissecting the model, telling them what part of the model is good, and then, again, it's a range, right? So
a variation on that question, and I don't want to
Sure.
move away from the presentation here. We've understood part of our role at the Institute is where research or data can help improve all the models, right? Rather than working with one, you have data. So it was usually framed as a British Columbia question, but after Mexico City many years ago, there was a sense that soil can amplify or reduce the effect of an earthquake. So having localized soil information was useful. So we did research on that, everybody. And are there some specific information pieces that are absent in Quebec that make it hard for the modelers to end up with the same result? I mean, without having the earthquake in Quebec, what are the things we can do to help bring more confidence in the modeling?
It's tough because, the models only release so much information to us. It's still considered the black box, so we can find out certain things. But in terms of not just hazard, but data, we always try to connect our clients and build a relationship with the modeling vendors to supply, data, claims data and stuff, so they can help recalibrate their models. So that's a step. I know that's not really the hazard part, but again, as users, we don't really know exactly what's part of the model.
Again, that might be a form going forward. I mean, if I could just make up an example, Quebec's got more old buildings. Would an earthquake under one model assumption assume old buildings get through okay, and another model say, I'm really worried about these old buildings, I think they're all going to fall down. And so it's a science question of building built long before, in Quebec, long before there was earthquake engineering advice. Is that building actually a safe building or not a safe building? That's a science question that the modelers might be making different assumptions about. And I'm quite surprised how big the Quebec differences are and how seldom we get asked questions to bring more clarity for Quebec, whereas we often get asked questions for British Columbia.
Anya's smiling, so I think...
I've got so many, you've asked so many questions, I've got so many to say. Well, I was just on a side note, some of the older buildings are better made than some of the newer buildings, so that's not necessarily
I live in an older building.
concern, yeah. Well, and it's
We're in an older
particularly
building.
in Quebec, which, Quebec City just celebrated its 500-year anniversary, so really old buildings are very sturdily made in general terms. But coming back to the original question, you said, why don't we get more questions about Quebec? And I think the answer, and Ken is right, that I am gonna talk about it a little bit later on, is the thing with cat modeling and managing the uncertainty of cat modeling is having to pick your spots. So many companies, certainly national writers, the severity or the loss potential in Vancouver, specifically, not even British Columbia, but Vancouver itself, dominates, and to a lesser extent Victoria, dominates their overall severity risk in cat, and so they're, the industry as a whole, I would say, is focused on it for that reason. And then as sort of a corollary to that, the fact that those indices for British Columbia are close to one, or closer to one than the other, it doesn't mean that there's consensus. In fact, if you run the same portfolio through these same two models, you don't get ones there. So part of the alignment in British Columbia there is the fact that they have different exposure databases, and they have a different assessment of what the industry overall risk is. And so it kind of, some of the differences in the underpinnings of the model are offset by the differences in the portfolios that have been run through the model. So there isn't, I wouldn't like you to think that there's like everyone's agreed on Western Canada and then Eastern Canada people have a really different opinion. I would say everyone has a really different opinion on everything. And literally every peril we've talked about and some of the ones Ken's about to talk about, everybody has a different view. So having said that, I mean, you're quite right that Eastern Canada is, in my mind, certainly a big question mark because there's very little data and very little attention being paid other than Quebec companies, obviously, who aren't diversified across the country. But I think that's why you're not getting the requests. I think the vast majority of people are focused on the places where if we got it really wrong, the industry might be technically insolvent, not just any one participant. Yeah.
Okay, moving on. So that was quake. Now looking at a similar exercise, and we did this for severe convectional storm also too. Canada-wide, actually the index is quite big here, 2 times. Alberta and Ontario, which are kind of the main drivers of SCS in terms of losses. We saw some significant losses in Alberta. You see actually a pretty big spread here, like 6.25 for the 250 year, 6 for the 400. So again, a big difference in terms of the two models. Manitoba, Quebec, not really wind regions, but again, here it just gives you an idea of the index between both models and using their industry exposure base, not specific client data. So again, modeling specific client data, you'll see differences in terms of the index. So we talked about modeled perils. So a lot of the losses that happen are actually non-modeled. So those are obviously very important, and our clients care about those too. So I'm just going to highlight some of the major non-modeled perils. That's hopefully models will be developed, and hopefully they'll be developed before significant events happen. For instance, like that 98 ice storm took 10 years for us to develop a model for that, and those numbers are still viewed as pretty high. Probably need some recalibrating, but again, 10 years before, after an event to build a model. So some significant, perils that we don't have models for is tsunami. So right now, current landscape, Canada's working on a national hazard map for tsunami. So even though we don't have a model, we have a map that can kind of identify the exposure or the hazards around this peril. Looking at some of the tsunami regions, Vancouver Island, taking this map, for example, along the coast here, we have between 1 and 15 meters of tsunami potential along the coast there. As we go in our coast there, the orange represents like a 1 to 5 meter. So even though we don't have models available for this type of peril, we have some sort of hazard mapping that can kind of guide us a little bit, and that's a start. Wildfires, again, big peril in Canada. As you saw, Slave Lake, second biggest event in Canada at approximately 700 million. A lot of the fires are man-made, approximately 50%. Again, no models available to help insurance companies or people identify potential loss. So again, what can we do? Again, we have weather indexes that can help identify fire damage for this type of peril. So it's a start. As long as we can kind of identify the regions and the potential for it, hopefully models will get developed. Yes, shameless plug for Guy Carpenter. We have tools also available for non-model perils. So iAccess, this RealCat tool that we have, we've partnered with vendors that supply us weather feeds. So for wildfires, for example, Slave Lake, we've actually paired up with vendors that can give us shape files or mapping layers of current fires that are going on. So for instance, each circle here represents a 1 kilometer radius for observed fires. So you look at this map here, we have our client's data, exposure mapped onto this map. Each dot represents the exposure here, and then we bring in the weather feeds, wildfire in this case, overlay to see what our client's exposure is to the event. We also have this tool for model perils also too, so it's not just wildfires. But again, it's a tool to help our clients identify the exposure. It might not tell you the exact loss, but at least they'll know where their exposure is amongst the peril. Lastly, flood's also a massive peril for the industry. Again, we have no model perils for that. Initiatives, yeah, there's been, people trying to develop flood maps, but again, I think the big problem is it's not regulated federally, and Paul, maybe you can kind of update everyone on a little bit more, but I think the problem is each water municipality has different, definitions of return periods in terms of water zones or hazards, so it's not consistent, and it's regulated, it's monitored on a provincial, so it's not across the board, so it's still tough right now, and it's a big job because Canada's a massive piece of land. So again, I think there are initiatives, especially in the heavily populated areas, but again, we're still ways away from it. And that's it for the modeled and non-perils, non-model perils. Talk about some enhancements that we might expect to see. So in RMS, no major updates are planned in the near future. They're doing a next-gen update in 2014. What does that mean? Might not mean updated perils or anything like that, but again, user interface, the whole database within the software is changing. 2015, there could be a Canadian quake update because of the Canadian Geological Survey that's coming out. EquiCats, no big model changes. They had their quake last year, but they're releasing a model version called RQE this year. Again, changing their whole interface, which makes it easier to use. So hopefully we're going to move into more of a multi-model approach, so clients start using it more, and the industry adopts this model a little bit more. And then AIR 2014, they've indicated they're going to do a full update to all their perils for Canada and introduce winter storm and hurricane. So we'll have more perils compared to, and not just rely on RMS. That's kind of an update on the model perils, non-model perils, and kind of Canadian landscape. I'll go to Anya to talk about model suitability and
I'm feeling kind of bad because Ken just explained all this stuff about models, and now I'm going to talk about whether or not they're all that useful and how useful, or how to use them responsibly, I guess is maybe the best way to put it. And Ken, just talked about model changes. Model changes can mean kind of big surprises and shocks to people trying to manage their cat exposure, and suddenly having a totally different evaluation of what that exposure might be. So talking a little bit about the uncertainty in the cat models, and then move on to what can we do about it. There are some really big sources of uncertainty in cat modeling. The one over which companies have the most control is the first one, data. Having the right address information is pretty critical, obviously. Reflecting multi-location, schedules properly, no bulk coding, capturing all of the policy terms, which can often be complicated, particularly for multi-location policies. But the more accurate and complete that capture is, the better the models can reflect what you would actually be on the hook for out of the economic losses that are generated by an event. bulk assumptions around insurance to value or other coverages or missing fields can have a material impact on the PMLs generated by models. And then the last bullet is actually what this picture is illustrating here, which is imperfect site into risk characteristics. And what the picture is attempting to show is two adjacent buildings, relatively similar. Obviously, one is more stories than the other, but relatively similar in construction, right next to each other. An event happens, and one is largely undamaged, and the other one, you can see the second story, even the foundation is massively compromised. Now, that could just be fortuitous. We know that in a lot of events, like particularly tornadoes and hurricanes, you see housing developments all built with the same construction at the same vintage, and yet, every other house is demolished, and the ones in between are unscathed. So we know that there is a fortuitous component, but there could also be an element of intrinsic lack of data or data integrity in the sense that this could just be shoddy construction. And if that's not reflected, if those risks are coded with the same construction, then they're going to get the same damage ratio, even though one is inherently riskier than the other. Another thing to anticipate on this data point, which came to me as Ken was talking about non-model perils, positioning yourself for new models, which hopefully we will see soon. Tsunami, from the address information, you can get elevation and distance to coast and things like that. But for wildfire, obviously you can get, from the coordinates, you can get where it is and how close it is to a forest, but you don't necessarily have distance to brush, like how clear is the land around the property. Flooding, you don't necessarily have distance to rivers and that sort of thing. So there's an opportunity there to start looking at those data fields and potentially capturing them even just for underwriting at this point, but also being prepared for when there is a model available to be able to put the best data and the most complete data into that model to get the most accurate results you can out of that model. Having said that, there are some sources of uncertainty you don't have direct control over, but they can be explored, as we'll see shortly. In the hazard module, which is the actual, forget about the exposures or anything, but just the events themselves. What is nature going to do in this country? There's a lack of historical events. We have to sort of backfill and infer, particularly for things like earthquakes that have such a low frequency. We have to look at information and try to infer what has already taken place. I just learned about paleoseismology. I'm pretty excited about it. I don't know very much at all. I'm going to tell you what I know, which is it's kind of like the analogy that I made to make sure I understood it properly is it's kind of like carbon dating for archaeologists to figure out how old an artifact is. This is going around and looking at soil and rocks and looking at a cross section of it and reading through that cross section what events seismologically took place in this spot over the last 1,000 years or however long. So it's kind of like I can tell from the patterns here that there was an event, at this time, give or take 50 years, of about this strength or this intensity. So we're doing that kind of thing. So it's not as though we're saying, well, there is no historical record, so we give up and shrug. But there are obviously a lot of assumptions inherent to that approach, and therefore quite a bit of uncertainty. We really know, as Paul was talking about earlier, we really know very little about the seismicity potential in low seismic zones like Eastern Canada. Eastern Canada is a particular concern, not just because it's in Canada, but also because we know that the type of zone is such that the events are felt at a low magnitude. They're felt over a very broad area. You'll remember the event we had in Quebec a couple of years ago, and I was sitting in the lunchroom at work and felt everything shake. And it was felt down in Pennsylvania. I think even in D.C. they felt the shaking. And I think the magnitude of that event was 6 or 6.1, so relatively low, compared to British Columbia, the types of magnitudes that we're concerned about. Even in areas of high seismicity, there's limited data, and we know that these events can be complicated, particularly it being oceanfront property, so to speak. And then on the engineering side, which is the vulnerability of buildings to these events, we just have pretty limited claims data, and the claims data is not necessarily captured at a granularity sufficient to refine the assumptions that go into establishing vulnerability curves for construction, occupancy, height of building, et cetera. We need those characteristics to be matched up with the claims data in order to use it to refine the assumptions. And yeah, I mean, this last bullet, the lack of understanding of structural behavior under severe loads. There's obviously a lot of scientific research being done in this area at universities and by the Institute and so on, but there's still a long way to go. This is illustrative, so the shape of this is not intended to be significant, but we know that catastrophe modeling is an imprecise science. There has been a tendency since the models were introduced in the late 80s and have evolved over time to sort of anchor to the number that they produce, which is understandable because it's hard to know what else to use. Like if I want to create an uncertainty band around the estimate that comes out of the model, how would I go about doing that, given that the model is maybe the best, most informed perspective that I have, certainly more informed than my own individual perspective. So we're going to talk about how you might go about doing that, but we do feel, Carpenter feels, and I think as a whole the industry is moving towards understanding that there needs to be a range in the estimation of this risk and not just a fixation on a point estimate. This is a quote from 13 years ago, actually from a GC Analytics report, which at that time was called INSTRAT, so an INSTRAT report in 1999, which says, if the 1999 CAT model says your 100-year return period loss is $1,117,243,572. What it really means is your 100-year return period loss is about $1 billion, but it could be $500 million or maybe $2.5 billion, something like that. That's actually still accurate today, unfortunately. I would not say that the uncertainty bands have shrunk in the intervening 13 years, although the models have grown more sophisticated. More sophisticated, unfortunately, sometimes means more assumption. So, which is moving in the right direction, but not necessarily reducing the uncertainty.
Well, Anya, at least in the first sentence, you rounded off the pennies.
Yeah. Well, I wasn't provided the pennies, or else I would have read those off too. This is an empirical example. This is actually a 1 in 100-year Florida hurricane loss from a couple of years ago. These results are actually, well, the first 3 results are actually taken from reports released by the model vendors themselves. It's reports submitted to the Florida Hurricane Cat Fund. They've all been scaled to 100. So their best estimate of the 1 in 100-year Florida wind loss, or Florida wind PML, is scaled to 100. And then they provided an estimate of uncertainty bands in that number. So the upside or downside potential reflected by each of the models. So AIR thinks they're producing an extremely accurate PML, and there's not a lot of uncertainty in it, like on the order of 5% either side. RMS looks like maybe they're not doing so good of a job, right? I mean, it's like almost a 40% margin either way. Not so confident in their results. And EquiCat, they really just came clean. Like, we could be 50% off either way. Sorry, guys, we can't get it more accurate than that. Well, Carpenter did their own study, and this is our view of what we think the uncertainty is, not specific to any one of the models, but in general for this peril, how much uncertainty there is in the results produced by any of the models. So, and I, as an actuary, I was trying to keep that a secret for as long as possible, or did I say that at the beginning? Anyway, I am an actuary. As an actuary, I'm really happy to see this. I didn't produce the Guy Carpenter results here, but I'm happy to see that the potential for having underestimated it is much greater than the potential for having overestimated it. Not necessarily that it's more likely that you over or underestimated it, but if you have, by how much could you be wrong? I mean, we know that certainly for all other insurance risks related to underwriting, like exposure risk, all of our loss distributions look something like this, right? Like probably right, but if I'm wrong, really, really bad, and if I'm right, or if I'm wrong the other side, it doesn't really get that much better. And for cat risk, of all things, it's the longest tail. I would expect the uncertainty of having underestimated it would far exceed the uncertainty of having overestimated it. So we actually have a paper that relates to this study that's listed on the slide later on, and I'll be referring to it throughout. It's a GC Analytics white paper on cat modeling uncertainty, which was released in December 2011, if you want more information on how these numbers were derived from there. Okay, so no more doom and gloom. Let's talk about what we can do. Right now, what we're doing, and this is what Guy Carpenter is doing. I think it's fairly standard in the industry. What we're doing on behalf of our clients, what clients are doing on their own behalf for those that license models themselves, what other brokers are doing for their clients, et cetera. So we start off with the client's exposures. We do some quality assurance to make sure the data is complete, credible, consistent, accurate. And then we run a model. For the most part, we run one. We do single model analytics. We take what I've just massively oversimplified and made look really easy, but isn't, and distill it all down into a report at the end that says, we did all this work for 2 months, and here you go. This is what we found out about your book of business and about the risk associated with it from a catastrophe perspective. And that provides a client the vendor-implied view of that client's risk or that company's risk. What we see coming in the future is a customized catastrophe modeling approach. So the first step, even the first step, hopefully, will be enhanced over time, that we're not just looking for the quality and consistency and accuracy of the data, but also looking at ways to augment the data with additional data sources pulled from other systems within our client's firm or external sources. And then we would like to attempt to quantify both the models and the non-models. I didn't specify on the previous slide that we were talking about a modeled peril, where a model is available. So on the modeled peril side, we would be moving to a multiple model approach. So to obtain all of the available views of the risk and producing a report on that. So that looks quite similar to what we just saw. But on the non-modeled side, companies should be doing something with this. And in the absence of formal models, you can add a load to the model perils. You can, parameterize your experience and try to fit a distribution of some kind to the experience you've had for the non-modeled perils. You can do scenario analysis. Not everything has to be stochastic, although obviously as an actuary I'm biased towards stochastic analysis. But something is better than nothing. And not only that, but scenario analysis, whether it's for modeled or non-modeled perils both, has the advantage of being customizable to your specific concerns and your specific exposures, and well understood by everyone, by senior management, board of directors, on down. So that's helpful to get your mind around.
Can I just make sure I understand some of the nuances here, because this is very exciting to me. So you specifically have used the term non-model peril and the illustration earlier of a tsunami or some of the...
Or wildfire, yeah, flood. Yeah.
But, I think there's non-modeled risks. Business interruption's a little vague to me, whether it's covered off or whatever. But the spirit of what you're sharing is costs that the client might experience that are in the formal model and costs that are not in the formal model, whether it's because it's a peril or it's in some other form. A part of the Thailand situation was, again, a whole series of different things that I'm not certain are in the formal models, right? Is that the spirit of what you're sharing here, is to try to help?
You are so in tune with what we're sharing here that you've anticipated the next step, which is, no, that's perfect. That's exactly it. there are models available for certain perils. By perils here, we don't mean heads of loss, we mean catastrophe perils, so causes of loss, as opposed to coverages or that sort of thing. And then there's the ones for which there's no model. And then there's also, for the ones where there is a model, do they contemplate everything? Are there things in my coverage that are not included, or my specific policy wording not included? Are there things that are just not included, period? Loss adjustment expense, not included in the model. So I've never come across a company that doesn't have to pay loss adjustment expenses. So that's something that affects every peril, every company in the industry.
In terms of the climatic models, do any of them, or related to climatic events, any of them take into account climate change? Are they attempting to? Because when you were talking about stochastic modeling and how, as an actuary, you like that, climate change tends to take a lot of those stochastic databases and chuck them out the window.
Yeah.
So I'm just wondering, are they trying to do that? Are they trying to become a little more inductive rather than deductive? How exactly are they dealing with that?
I'm not going to give you a definitive answer on that because I'm not the authority on that. I will definitely I'll take your email address and I'll get back to you. But the only concrete example I know of which is not exactly climate change but related, is the U.S. hurricane model, where following 2004, Charlie, Francis, Ivan, Jean, and then 2005, Katrina, Rita, Wilma. There were actually like 23 named storms that season, more, 28. RMS determined that, there was, industry concern that this level of frequency and frequency of severity was not contemplated in any of the event assumptions in the event set. And so RMS responded by giving licensees the option of adjusting the likelihood of these events upward. And they called it the near-term view as opposed to the long-term view. So the model is attempting to do a sort of long-term over the, long cycle, not just Niña, annual cycle, but the long, centuries, millennia cycle. That's what the model intended to produce. But there was a recognition that right now we're in a period of elevated sea surface temperatures, whether that's due to climate change or something else, whether it's temporary or permanent is debatable. But we know that that's the case, and it has been for a while. So they essentially said, you know what, maybe our likelihoods, our frequencies, are not representative of the current market, and you're trying to manage your current exposure. So we'll give you basically a switch that you can say, like, jack up the likelihood.
My concern there is essentially then you have a model using another model, and I kind of think some of the error bands would be going really wide when you run into situations like that, trying to link one model with the previous model and then trying to figure out where the error issues are.
Actually, no. What they did was they just embedded two sets of likelihood. So it's the exact same event set,
okay,
but two sets of likelihoods of that specific event happening. So it was really like a switch. It was kind of like if you say, I want to include or not include loss amplification.
So they were just doing
It's the same model, but it's sort of like in the short term, maybe I want to recognize there's a higher likelihood of having hurricanes this coming year. And then when I feel that cycle is over, whether it takes 3 years or a decade, then I can move back to a long-term view. It's within the same model.
So it's completely inductive.
It's a choice.
There's no real extra error band.
No.
Okay.
No.
So all they're doing is changing the frequency.
Okay.
Yeah, and you obviously have the option to run both views and look at how much of an impact. You can isolate the impact.
And there's no real statement as to whether which view is correct. They're just saying,
right.
And if this is the case, then look at this. Okay.
Right. And I mean, in a sense, that's what we're moving towards here, which is they're essentially giving you ownership over what you feel is the best assessment of your risk, or what your risk tolerances are. Do I want to be conservative and make sure that I've taken, or I've at least looked at what a more conservative view is and potentially an alternative realistic view of the risk is, and then you can discard it or use it or blend it, or you can do with it what you will. But they're putting that power in your hands, which is good. That's a good thing. So yeah, the model suitability analysis is sort of what I would broadly call exactly both of these questions around ancillary coverages or things that are not included in the model, how much of my views of what's happening with climate change are reflected in the model? And if none of it is reflected, how do I incorporate it? So we have sort of a, wow, very shaky. We have sort of a three-pronged approach.
It's probably the subway.
Yeah, something. Hopefully not an earthquake. So we would have a three-pronged approach where we would produce a traditional catastrophe report, which has a multiple model approach, but sort of the standard view that corresponds to the vendor implied view. We'd have a model suitability analysis of those models, which I'll get into in a little more detail, so it gels. And then we'd have a non-modeled peril report as well to supplement that and to take into account those other things that you will have to cover if there's an event. And all of that combines into the client's own comprehensive view of the risk. And that lines up nicely with regulatory initiatives such as Solvency II, the draft guideline that OSCE's just released on earthquake risk. Just generally speaking, this is what people want to see. Rating agencies are encouraging and open to looking at the client's view. So they're okay with making changes to what comes out of the traditional model sort of unadjusted, as long as they understand the rationale for it. So on the model suitability analysis side, we have three pieces. On the evaluation, we actually have 9 pieces, but these are the first 3. Evaluation, there's sensitivity testing, which is looking at the sensitivity of the model results to primary and secondary characteristics. So building height, construction, occupancy, roof type. I mean, the list goes on, but you can sort of isolate each of these variables and see how sensitive are the PMLs, how material of an impact does it have if I change these assumptions or I vary these assumptions. Second component, loss validation. So that would be comparing to experience. We do tend to focus, well, depending on the purpose of the analysis, but often, certainly from a reinsurance perspective, we tend to focus on the high severity, low frequency events, but that's not to say that you cannot look. I mean, the model produces all of the potential events, so it's not to say that you can't look at the more frequent, more regular events and see how those compare against what the model is saying it should look like. For that information, you have a lot more claims data to compare against. The third component is scientific appraisal. So things like newly released research in this field, new report from the Institute of Catastrophic Loss Reduction, Canadian Geological Survey updates. If you know, or even there was research, what prompted the 2009 update to the RMS model was research on attenuation of seismic waves through the ground. So you can incorporate the latest and greatest in these things, and you can look at the models and say, do they or do they not reflect this, or how consistent are they with the cutting-edge research? All of that builds into a grid, which I'll show in a moment, because otherwise, if you're looking at each of these things a variety of ways, it can get very overwhelming, and in the end, you don't know, do I like this model, do I not like this model, is it too low, too high, what do I do with it? And that grid logically implies ways to enhance the model, or in fact, to customize the risk profile that goes into the model so that it produces results that are appropriate. So that's just integrating the evaluation stage into the CAT risk assessment process. And then the last piece, and arguably the most important piece, is communication. And that's communication, obviously, with the board, communication with your reinsurers, communication with rating agencies, et cetera, all of the people that are going to hold the company to account for this assessment. I do not know why that went from black to white. I'm going to skip this for a second and talk about the MSA grid. So what is that exactly? Well, the MSA grid is a series of criteria that are going to, sort of decision criteria, that are going to determine your view of a particular model for a particular peril. This example is taken from European wind, believe it or not, but it's meant to be illustrative, so this, it's not specific to the country or the peril. It's the principle that I'm trying to communicate here. So these are defined by the company, in consultation with whoever they have that's authoritative on the subject or has a view on the subject, be it their reinsurance broker, a consulting actuary, whomever. So if we take this example and we look at two models, Model 1 and 2, doesn't really matter what they are. The first criterion there that's given as an example is sensitivity testing on building code. And so the client seems to be reasonably happy that each model performs equally along this criterion. The second one is validation against windstorm Klaus, so actual client losses on an actual event, which was, I believe, 2009. I believe it's 2009. The first model was, for CAT model, relatively close, only 10% error. And the second model had a 200% error. I suppose it may matter up or down. 200% error, if it's conservative, might be viewed as good if you're trying to be conservative, but certainly if it's underestimating, that's not a good sign. And then there's another loss validation. Sorry, I didn't specify here. This is sensitivity testing, loss validation, and scientific analysis. So the third criterion there is another loss validation one, which is looking at the high frequency events. So Model 1 seems to do well with the big events. It's not great. It's not so good on the small events. I would say that's possibly going to be a common phenomenon since the models are generally focused on the large event evaluation, since that's the purpose to which they're generally put. But Model 2, once again, does a very poor job of matching not only the big events, but the small ones as well. And then the third criteria there are scientific research on damage functions, so vulnerability of buildings, and event footprints, so the shapes of events. And the first model seems to match the current research on the vulnerability functions. The second model does not. And on the event footprints, both of them match a study that was released by the UK Meteorological Agency. At any time, you could then add a third model if a third model becomes available, or if a new setting in an existing model becomes available, such as the near-term view. You could add that to the table as Model 3, which is a variation on, say, Model 2. And does it take care of the areas where, on the long-term view, it's not effective? This is obviously just a theoretical case, but you could take change an assumption in there and see if it rectifies the places where there are red boxes. In this case, I believe, is a completely different model. And it turns out that on the building codes, it doesn't have the most up-to-date building codes. So it's not being maintained. The vintage of the model is old. It does a better job than Model 2, but a worse job than Model 1 on loss validation, both of large and attritional events. But on the vulnerability side, it's matching claims experience, not necessarily matching current research, which was the criterion up here, but it's matching the claims, so that's good. But it's not up to date on the event footprint. It's not consistent with the study that was released. So obviously this is going to be something that's an evolutionary process, the selection of the criteria, the study of the models to determine how well they do against those criteria. But you can start with just loss validation. You can start with just a few criteria and build it up. And in so doing, you gain a better understanding of how the models work and how they compare against each other and how they compare against your own experience. And it also sort of points you towards on which model should I rely more thoroughly. And are there ways in which I can adjust some of these models or blend or bend or fuse or morph? There's a lot of terms about this science now. But it gives you a roadmap for what to do and what I need to make adjustments for. Whether those adjustments are as simple as adding a load or fusing models together. And obviously, taking this type of approach lends itself well to documentation and communication. It's very clear whether it's to regulators or to the board of directors or whomever, what thought process went into the ultimate decision that was made on saying this is what we feel our catastrophic risk looks like for the coming period. I forgot there's all these fields, but I'm just going to go back to the previous slide. So in the end, after you've gone through that process, and as I say, the process can start out simple and get more robust or more complex as you have more time to do research or more ideas about what you want to explore. In the end, the idea is to say, I have these divergent views of a peril. You know, Ken talked about Model X versus Model Y. What do I do? Do I just take an average? Are there more sophisticated ways that I can incorporate this? Are there ways that I can actually take a little bit from Model A, take a little bit from Model B, throw in a little bit of customization for my portfolio and come up with a completely separate but more accurate, less uncertain estimate? And I, again, will refer you to that paper that I was talking about on model uncertainty. It explains all of these terms I just used about bending and blending and morphing and fusing. There's time, and I did not have time to prepare a full talk on that topic. Okay, so I think we're actually at the conclusion. One last point, which I mentioned, regulators. This is sort of an approach that's being encouraged within Solvency II. I've definitely noticed some similarities in both what OSFI's already done and what they're talking about doing in the Canadian market from a regulatory perspective with what's been done in Europe. So I think the fact that this approach is being adopted and accepted within the Solvency II framework is encouraging for what we may be required to comply with in the coming years. So after all of that, what can you do? What can you be doing, or what should you be thinking about as you're looking at this topic? That last bit that I was talking about is obviously relatively young. At the same time, I think there are some pretty easy wins in that sense. You can look at your claims data and evaluate models against it. That's relatively straightforward to do, and it's definitely an improvement over what's being done right now, I would say, generally speaking. Bear in mind that models are models and there are inherent uncertainties in them. The data that goes into the models is paramount, and the scientific hypotheses underlying them have a huge impact on the assessment. As I was saying earlier, Western Canada, that's been the focus for 20 years, longer, still hasn't been ironed out. There still isn't consensus. Each of the three models for a fixed portfolio will produce sizably different results. And I am also hoping that we don't have to have a massive event in order to prove one of them right or wrong, or any one of them right or wrong. The suitability analyses of models will be increasingly important. We don't want surprises like Slave Lake. We don't want surprises like, right? I mean, we want to be more assured that we have a good sense of what could happen, and we're not suddenly surprised that there are loss adjustment expenses, right? I mean, that's, something that we should be able to anticipate and adjust for. And yeah, last but not least, although it sounds counterintuitive since Carpenter offers catastrophe models running for our clients, but you can't just assume it's useful. And fortunately, we're moving into a time, hopefully, if the model enhancements actually show up, where we'll have alternative views for a variety of perils. Ken didn't speak to it explicitly, but EquiCat is also doing research into hail and liquefaction for their quake modeling, and so we're hoping to see more models on currently non-modeled perils, but also on the existing perils, so that you have some alternative views to work with and fuse together. And that's just a list for your convenience or interest. All of them are available on our website, on the Carpenter website. These are just some recently, one came out this week, and just in time for Monte Carlo. So, and we're still although there's been recent activity, fortunately, none of our local activity has changed us from being a cold spot to a hot spot. So we're still in this cold spot category. I don't know if there are any more questions.
When you're doing all this model comparison or so on, does it kind of disturb you that you can't get a look under the hood, so to speak, completely of the model? When you're playing with error bars, and then you're talking about enhancing it, and, you know, at times you want to say, look at it, well, what exactly are they doing?
Here? Yes. Oh,
yeah.
Yes. Like every day?
Yeah.
Yeah. Well, I'm an actuary. I like to know all the details, and, yes, it's frustrating. At the same time, it's understandable.
No, I understand why.
Because it's their proprietary software, so they don't necessarily want to give away their intellectual property. But yeah, it's extremely frustrating, and at times it can feel a little bit like you're groping around in the dark trying to figure it out. And just when you figure it out, they change the model. But it's worth it, I would say, and you can get to the bottom of it. Particularly, I think the more informed you are going to the table with the model vendors and talking to them about their assumptions, the more you can infer from what they're saying, or you can sort of deduce, so to speak, because you've already done some legwork of your own. I think also the model vendors, how they'll deal with it remains to be seen, but I think they're aware. I mean, Ken talked about the next generation platform. That's to make it easier to use multiple models. They're becoming aware that clients aren't going to be choosing between the models. They're going to have they're going to want to look at various views, and they're going to have to play nice in the sandbox with each other, and they're going to have to be a bit more forthcoming with information so you can comply with the various constituents that you have to answer to. So, like I said, we'll see how they deal with it, but I expect they're going to have to be more forthcoming. And just developing the next generation platform to make it easier to communicate and translate databases between models is a step in that direction.
A comment, hopefully not cutting off the questions, but anyway, just thank you. That was in a relatively concise period of time. It gave us the history of models. It gave us a sense of what the models are doing now and how they differ and where their similarities are. And you told us about the future and what's coming next. So I think that was a really good presentation. Thank you.
Thanks for going easy on us. We didn't have a lot of notice.
If this quickly thrown together choppy presentation, I'd love to see your...
I had to reach for my security blanket. I couldn't even remember the 2011 global event. But so be it. Hopefully it was informative. If you have any questions, if you think of questions later, just let us know. We're happy to answer, happy to help.
Okay.